Hello and greetings from the Main Tower of Hellerbar in Frankfurt. This is our usual quarterly update for the primary markets and covered bonds, senior unsecured and SSA. My name is Thomas Kors. I run the financial institutions business at Hellerbar, and I have today with me a new guest, Alexander Kirsch from our syndicate. Hi Alex.
Thank you, Thomas.
Basically we had a fantastic start to the year. The quarter was great. We hit something close to 700 billion euros in total volumes across all asset classes in the European marketplace, dominated over 50% by the SSA sector, unfortunately, because that's not our favorite. But FIG was second strongest with 30%, and amongst those, roughly half was covered, which is, of course, our favorite asset class. Well, in total, the most amazing thing that we had, the thing that really changed in the first quarter was we had a focus on longer tenors for the first time in quite a while. We had almost half of all issues in the market issued at tenors 10 years and longer. That was again dominated by the SSA sector, but also the coverts had quite a run at maturities 7, 8, 9, 10 years, and actually today we had a 12-year from a Dutch issuer. But more to the details of the individual asset classes will come from Alex. So Alex, why don't you lead us through the covered bond sector?
Yeah, thank you, Thomas. Yeah, as you can see here on the chart, we had a very strong beginning in 2024. And you mentioned a very important point, Thomas. The duration of issued covered bonds increased massively. So we have seen a lot of 5, 7, 10-year covered bonds over the last weeks. And this was not possible in 23. And therefore, we had seen a very strong momentum in the beginning and a very good start in covered bonds.
Why now long years?
Sorry?
Why now long tenors?
Why long tenors? There are actually two reasons. On the first hand, is that last year long-dated covered bonds haven't been possible. We have only seen transactions between 3 and 5 years. And secondly, investors are keen to invest in long-dated bonds because they expect interest rates to decrease over the year.
That possibility, however, that was because the spread uptick that the issuers would have to pay was too high, right?
Absolutely. Because
the market would have done it, investors were there, just the issuers didn't want to pay up. Okay, what about senior pref?
Yeah, senior pref is also very interesting. You can see we are very close to the record line in 23. The senior preferred demand from banks, they are very strongly related to the deposit business, and depending on the development of the deposits, the demand for senior preferred is more or less. We see a good demand also coming up over the next months.
And what about senior non-pref?
Non-pref, yeah, we are very close to a record. Actually, we are on a record point. A lot of senior non-preferred had been issued due to very, very favorable market conditions, and a lot of banks are looking for MREL eligible liabilities. So therefore, there was demand from the issuer side, but also from the investor side due to the strong market we have seen.
Sounds almost like a Goldilocks scenario. Talking about Goldilocks, what about the SSA sector?
Yeah, the SSA, I almost say as usual, they are had a very strong beginning. We are very close to a record again. So, there is a lot of public spending, and therefore there is a lot of demand from the public sector side for issuances.
I'm not so keen on records from the SSA sector because somehow it always seems to end up in tax burdens. But anyway, all of this issuance activity must have some effect on spreads. So let's talk about spreads. What have we seen in the performance of spreads, especially in Germany versus the rest of the European marketplace? Because I think a lot of issuers in Germany are not quite happy with the spread levels right now. So what's the story there?
I totally agree. When you look back almost a year, you see that the difference between euro-covered bonds and Pfandbriefe had been approximately 15 basis points. Now we are almost 8 basis points, so the German Pfandbrief underperformed, unfortunately, the euro-covered bond market. The reason for this, I would say, is on the one hand side, the German Pfandbrief market is still very, very big, and there is a lot of supply coming from Germany. And on the other side, there had been some bad headline news from Germany, which are influencing somehow the covered bond market.
I also think there's another reason, and this is the directive, because now all of a sudden German investors, which are the majority of investors, have a much wider choice that is easily comparable. That wasn't always the case, don't you think?
Absolutely, this is absolutely true. I met investors in the past, they said, as long as there's the European covered bond label, I take the Pfandbrief or the covered bond with the highest spread. So this is what opinion from one investor. So therefore, yeah, this is true. The German Pfandbrief was quite expensive, but as you can see, it's still the tightest.
Yeah, gold label. But hang on, there is another convergence story you wanted to talk about, right?
Absolutely. If you compare credit and rates, you see on this chart, it's a very, very small, but anyhow, the lines on the bottom are the rates products, like the SSAs, but also the fund preferred covered bond market. And on the top, you see the credit market, senior preferred, non-preferred, and corporate bonds. And while the rates market underperformed, or let's say the spreads widened slowly, as we have seen in the charts before, you see that the spreads on the credit side tightened over the last month.
But this cannot continue, can it? I mean, in the end, that means either covered bonds are far too cheap or senior unsecured is far too expensive, or both. So what do you think is going to give?
It's absolutely true what you are saying, and this is also the opinion of a lot of market participants we are talking to. So there is the idea, or let's say the hope, that covered bonds are tightening in again, that the gap increases again, but there's also the risk that senior non-preferred and preferred is maybe going to widen.
So that it could rain or the sun could shine, that will depend on the weather. Thank you very much. But jokes aside, what will drive volatility going forward?
The volatility going forward will drive definitely a lot of event risks. We have maybe in front of us, hopefully not, but there is the conflict in Middle East, which is a very present topic. We have also the war still going on in the Ukraine. We have still the central bank policies, let's say the decisions from the central bank, especially from the Fed and the ECB. And you still can remember that in the beginning of the year there was priced in a cut of 6 to 7, and now we are talking about 1 or 2 cuts until year end. So there is still room for volatility. We have the inflation data and the labor market data, very important to have an influence on markets. And last but not least, we have the US elections in November. I would say this can be an event risk, hopefully not, but anyhow, this is what we still have to have in mind when we go to the second half of the year.
So important which old guy will rule the Western world. Yeah, thank you very much for that. We didn't want to go through a hell of a lot of more slides, but just quickly at the end of this, the outlook for the remainder for the asset class, will we see a lot more issuance, or are people expecting more that the second half of the year will be subdued, less issuance than last year?
Generally said, I think you can say that 50% of the funding is done in all of these asset classes, from SSAs, covereds, and senior preferred and non-preferred. So this means that the remaining 50% is divided into 8 months and not into 4. So therefore we see less issuances over the whole year. But the mix between, or let's say the quotation between new issuances and redemptions will be a little bit more soft.
Okay, thank you very much for that fantastic summary. As we see on this list, we see a lot of similar points we had in previous updates and outlooks, and yeah, unfortunately some of these sort of danger points do not want to go away. I hope soon these war issues will be gone. We had a similar story with the pandemic. Finally, that has gone, we hope. And therefore, let's look to a brighter future, at least for the markets. You've heard it all. There will be more in the covered bonds here coming at the beginning of this year, i.e. until the summer break. After that, we expect it to tone down a little bit. So with that in mind, thank you very much for tuning in, watching our update. Hope we see you soon again, either live or virtually. I'm Thomas Kors. This is Alexander Kirsch. We're from Hellerbach. Thank you very much.
Thank you.